In this week's market update, UK avoids recession, Bank of England keeps rates on hold, and British Steel in rescue deal safeguarding up to 4,000 jobs. The UK economy has avoided falling into a recession but has grown at the slowest annual rate for almost 10 years. The Office for National Statistics confirmed the economy grew by 0.3% in real terms between July and August. To qualify for a recession, the economy must decline for 2 consecutive quarters. The pressure was on because the preceding April to June period had shown a 0.2% fall, so another negative reading would have confirmed a technical recession. However, while a formal recession has been avoided, growth is still sluggish by historical standards. In fact, growth over the last 2 quarters has been the slowest since the financial crisis. But the numbers may still change. They are the first reading of the economic data for the 3rd quarter and are based on only around 40% of the data that will be eventually used to calculate GDP. Readings will be updated in the coming months and revisions could still be made. If they remain broadly the same though, it will confirm that the UK is sharing the pain of a widespread global slowdown in growth. Central banks in the US and Europe have taken action to stimulate their economies, with the Federal Reserve and European Central Bank loosening monetary policy this summer. Last week, the Bank of England took on a more dovish tone too. It indicated it is prepared to cut rates if the economy slows further. The bank said underlying UK growth had slowed materially in 2019 because of Brexit uncertainties and a wider global slowdown. While the Monetary Policy Committee voted to keep rates on hold at 0.75%, 2 members called for rates to be cut to 0.5% immediately to support growth. The Bank of England still expects UK economic growth to pick up, assuming an improvement in global growth and an end to the current Brexit deadlock. However, Governor Mark Carney acknowledged that neither is assured. A key rate to watch is inflation. Michael Saunders and Jonathan Haskell, the 2 external rate setters who called for the cut, pointed to the current rate of inflation, which at 1.7% is below the bank's target of 2% and is expected to fall further next year. The bank expects inflation to drop sharply by next spring to around 1.25%, due to planned cuts in regulated energy and water bills. Interest rates are traditionally used as a way of controlling inflation. If inflation starts to accelerate rapidly, a rise in interest rates can dampen consumer spending as households have less spare cash to spend at the end of the month. So what is the outlook for inflation looking further into the future? The bank still expects inflationary pressures to build after the anticipated drop in the spring, but currently forecasts it will only be slightly above its 2% target, even at the end of 2022. The latest UK inflation data will be released on Wednesday. So for now, borrowers can at least take comfort from the fact that inflation appears to be under control. Shame the same can't be said for some of the other uncertainties investors face, with a general election before Christmas and a Brexit extension until the end of January on the horizon. In other news, British Steel has been rescued by Chinese firm Jingye. Chinese industrial conglomerate Jingye will buy British Steel in a deal which will safeguard up to 4,000 UK jobs. The Chinese group said it planned to invest £1.2 billion in the steelmaker over the next decade to upgrade plants and machinery, improve the company's environmental performance and boost energy efficiency. British Steel provides a third of all steel in the UK and specialises in railway tracks and girders used in construction. It's the country's 2nd largest steel producer after Tata, with plants in Scunthorpe and Teesside. It's had a turbulent history, with the UK government repeatedly refusing to bail the company out. The business has also suffered from higher iron ore prices, a weak pound in which it buys raw materials, and falling steel prices. Roy Rickhurst, General Secretary of the Steelworkers Trade Union, welcomed the news, but warned whatever government is in place in the coming weeks, it is vital all steps are taken to successfully conclude this process. Until a deal is completed, all viable options to securing the business should remain on the table. Looking ahead this week, we can expect GDP data from Germany on Thursday. This will show whether Europe's largest economy is in recession. Exports, which are crucial for the German economy, rose 4.6% unexpectedly in September, thanks to a rebound in trade to other Eurozone countries, as well as the UK and US. This compensated for the weak demand for German products from China. The export-focused German economy has been struggling recently due to the US-China trade war, uncertainty over Brexit, and a sharp decline in the car industry as it moves away from fossil fuels. In company news, we can expect results from property developers Land Securities and British Land this week, which will give an indication on the current state of British retail. With Christmas decorations now up in shops across the country, all eyes will be on how resilient the UK consumer will be during this key period for retail. Both companies are sensitive to consumer spending, with Sheffield's Meadowhall shopping centre in British Land's portfolio, while Land Securities owns the giant electronic billboard display on London's Piccadilly Circus. And finally, whilst on the subject of retail, yesterday was Singles' Day in China. Singles' Day takes place each year on the 11th of November, when the date is made up of 4 ones. Starting out as a festival celebrating singleness by students in Nanjing, Chinese e-commerce giant Alibaba has turned it into the world's largest online shopping festival. Now in its 11th year, the shopping spree has broken new records, bringing in £23 billion worth of sales for Alibaba in just over 16 hours of trading. With results like these, it's easy to see why China is keen to develop its domestic economy, as it continues to battle with the US over trade. That's all for this week. For more updates on the market and what it could mean for your money, visit the Markets and Insights section at fidelity.co.uk.